UK buy-to-let is dead unless you're Blackstone. Pension funds and asset managers like Blackstone are piling into UK buy-to-let, and the odds are stacked against private investors. Private landlords are getting squeezed out, and this is supported by recent data from HMRC and research by Zoopla. Tighter regulations, higher costs, tax changes, and more rights for tenants all mean that for many landlords, the juice is no longer worth the squeeze. 1/3 of them now generate less than £10,000 a year of income from their rentals, and their actions speak for themselves. According to data from National Residential Landlords Association, 26% of landlords sold some of their rental properties last year, and a recent landlord survey carried out by HMRC found that 1 in 5 landlords plans to sell up in the next year, and 1 in 3 landlords plan to sell up in the next 5 years. Meanwhile, only 4% plan to buy more in the next year and only 8% in the next 5 years. For the majority, the main reason was tighter regulation, which includes more rights for tenants, and tax changes, which includes Section 24, a change that meant landlords who are not basic rate taxpayers could not deduct all of their finance costs if the property was in their personal name. This change was disastrous because it meant that in the eyes of HMRC, landlords had more income and potentially moved up a tax bracket to pay more tax on more income that they didn't have, because they still had to pay the mortgages. In 2016, I didn't like the look of all these changes, and I sold a portfolio of 78 tenants. Right after that, the 10% wear and tear allowance was removed, and in the same year, the 3% stamp duty surcharge was introduced on second homes, which recently increased to 5% on top of rates that are already very high. Between 2017 and 2020, the mortgage interest relief changes were phased in, and now landlords in the UK will soon see the Renters' Rights Bill come into force, which will scrap no-fault evictions and fixed-term contracts. Tenants will be able to leave at any time with 2 months' notice, and landlords will need a good reason to ask them to leave. Rent increases will also be restricted. There's more. New EPC ratings are coming. These are energy performance certificates. From 2028, it's likely that new tenancies will have to meet higher energy efficiency standards, although the whole system may be changed. But if it isn't, it's expected that all rentals will have to comply by 2030. For those landlords that wanted to keep their portfolios, they mostly had to adopt the use of corporate structures, which was a time-consuming exercise and a costly one. They had to suffer increased cost of finance because mortgage rates are higher for limited companies. For ultra-high net worth investors, this probably doesn't matter because they tend to use companies and trusts in any event. And for debt, they use structured products rather than your standard buy-to-let mortgages. But nonetheless, the changes in the market are profound. And according to Zoopla, in the last 5 years, average rents are up 25% in London and 33% in the rest of the country. Unsurprisingly, escalating rents are attracting institutional money, and it's no wonder institutions want a piece of these returns. Let's take a look at some of the main players. Pension Insurance Corporation, PIC, has £13 billion invested across retirement living, affordable housing, build-to-rent and student housing. USS has a £405 million deal with Sage Homes, which is backed by Blackstone, for 3,000 shared ownership homes rebranded as Sparrow. Once again, Blackstone backed Sage Homes, and Leap Living, one of the UK's largest for-profit registered housing providers, is in a landmark £819 million JV with Vistry Group for nearly 3,000 homes. Aviva investors, over £750 million invested in build-to-rent and single-family rental units in the last 18 months alone. They're working with major house builders like Barratt with an ambition to triple their UK residential exposure in coming years. Greystar has built a $14.5 billion portfolio in the UK comprising 11,841 student units and rental units. And then there's Granger, which is a FTSE 250 residential landlord with a portfolio valued at £3 billion. They're active across private rented sector, build-to-rent and regulated tenancies. The trend in the UK is clear, and there's no arguing with it. Historically, a cottage industry, so private landlords still dominate, but they're cashing out. Pension funds are buying in and building. Meanwhile, Middle Eastern sovereign wealth funds such as QIA, Adia, Mubadala and PIF are snapping up UK trophy assets, including Heathrow, Gatwick, Selfridges, Harrods, The Shard, Dorchester, Claridge's, Berkeley, the Connaught and more. Football teams like Newcastle United, Manchester City, as well as ports and shopping centres. The list goes on. Let's be frank, the UK government wins votes by favouring tenants, and they don't support landlords. They've made that clear with tax hits, tenant-first regulations and bureaucratic red tape. Meanwhile, Middle Eastern governments are actively campaigning for you to invest in their real estate. They're creating visa routes, tax-free zones and investment-friendly frameworks to welcome landlords and investors. In the world of property investment, capital flows where it's treated best, and right now that is in Britain.